the assets is decreasing, that means the decrease in the assets is always increase your inflow. So that's why it would be added. So decrease in stock is always create increase in cash flow, and that is 30,000 minus 20,000 comes to 10,000. So in case of a decrease in current assets, it's increase your cash flow. Let's see the debtors. Here the debtors is beginning in the 25,000 and at the end is rupees 40,000. Here it is reverse than the stock. In case of stock it was decreasing, but in case of a debtors it's increasing. If it is increased, then it would be work in the reverse. It means that it is decrease your cash flow. Because of increase in debtors, it's always considered decrease in cash inflow, and that's why it's considered a deduction. The difference between that 40,000 and 25,000 comes to 15,000. See the next item, that is current liability, creditors. In the beginning the creditors is 20,000 and at the end the creditors is rupees 30,000. Here the formula is reverse than the formula applied in case of current assets. The current liability last year, that means we can say it's a beginning year, it's 20,000 and the current year ending, it's 30,000, it's increase. In case of the current liability is increase, it's always increase in your cash inflow. That means increase in current liability is always increase in your cash inflow. The difference is 30,000 minus 20,000 comes to 10,000. See the next item is bills payable. Bills payable beginning of the year is 6,000 and at the end of the year it's 3,000. So the difference is rupees 3,000, but it shows very simple way the bills payable is decreasing. In sense of if the current liability is decreasing, that means it's cash outflow. So in case of a decrease in current liability or in case of a bills payable, it always shows a decrease in cash inflow of rupees 3,000. So all the transactions are recorded. Here the changes of these two, it's 20,000. It is added. So 60 and 20, it's 80,000. This total it comes 18,000 here. So 80 minus 18 comes to 62,000. This is your net cash inflow of the business. See, what was your opening profit? It's 50,000. What is your net cash inflow after all the transaction? It comes to 62,000. It shows that you have a net cash inflow of rupees 12,000 at the end of all these transactions. Now moving to the next topic, that is adjusted profit and loss account. Here I just want to mention that whatever the adjusted profit and loss account informations to be considered at the time of preparation of fund flow statements, in the same way, in the same manner, it's supposed to be prepared at the time of cash flow statement also. So all the informations which was actually considered as a non-cash items, non-funded items, and the amount of items which are actually affected in a financial statement twice would be reversed here in the adjusted profit and loss account and find out the right and correct net operating profit, adjusted profit out of that adjusted profit and loss account. So here I am not going to tell you again the same format and the same pro forma of adjusted profit and loss account, because of which was already discussed that the adjusted profit and loss account at the time of fund flow statements. Moving to the next point, that is uses of cash flow statements. Uses of cash flow statement is there are n number of uses of cash flow statements which are maybe taking an advantage of the firm, enterprises, organizations for the managerial developments, for the future path of actions, for the efficient cash management, for the identifications of operating activities and financing activities and the investing activities. So n number of uses are there for different activities, for the different transactions. These uses may be helpful. Let's begin. Helps in efficient cash management. Cash flow analysis helps in evaluating a financial and cash position. Cash is the basis for all operations, and hence a projected cash flow statement will enable the management to plan and coordinate the financial operations properly. So according to the coordinations of all the activities, the financial plan to be executed properly, the cash flow statement would be helpful. The management can know how much cash is needed, what type of cash and how much period of cash has been required, from which source it shall be obtained, and how the cash could be managed in the firm. So that is all about the helps in cash efficient management. Next is helps in internal financial management. Ultimately, the cash is all about the management of finance. Cash flow analysis provides information about funds which will be available from operations. So whatever the cash is available in the business for the operations, they are trying to manage that. This will help in management in determining the policies regarding internal financial management. So it concerns that whatever the finance has been actually involved in all the different activities like operational activities, financial activities and investing activities, these activities may be handled by the internal managers, that the amount of fund is available and asked by the different activities for the different allocations of funds. So they manage it. The management can plan out payment of dividends, possibility of repayments of long-term debts, planning replacements, and the amount of fixed assets may be changed if it has good idea for changing and according to the timing when enough cash will be available or not. So this is all about that part of the second uses. Next is disclosing the movement of cash. Now here the amount of cash has been available, but how it is actually a moving of the particular cash liquidity in the business, where it is actually comes, that means cash inflow, and where it goes out, that amount and that information has to be disclosed. Cash flow statement discloses the complete information regarding the cash movement, the increase in the business or decrease in the business of cash after each transactions. The reasons hereby affected has to be known, and this would be known through the cash flow statement. It discloses the reason from low cash balance despite heavy operating profit, or for heavy cash balance despite of a low profit. So in a vice versa profitability situations, the cash liquidity, it may be not actually available in the business, would be reflected through this particular sections. However, comparisons of original forecast with the actual results highlights the trends of movement of cash which may be otherwise understand for taking some amount of detections and some amount of the informations would be identified. Here the next point is disclosing success or failure of cash planning. The extent of success or failure of cash planning can be known by comparing the projected cash flow statement with the actual cash flow statement. As a result, the necessary remedial measures can be taken. So when you are going to compare that actual cash flow with your projected cash flow, you would be automatically understood that where the changes is required and what was the deficiencies, and find out the improvisations for the same. Here the another objective is to access a cash flow from operating activities. Cash flow statements provides informations about the cash generated from all operating activities. So that means whatever the operating activities are available, the cash flow has been generated from that operating activity. It provides explanation for the difference between the net profit that was calculated on the accrual basis and cash from operations calculated on the cash basis. So that means the amount of profit which was already calculated on the basis of profit and loss account, and the amount of profit has been realized and identified on the basis of adjusted profit and loss account, and the difference would be identified. Calculations of net profit on a cash basis are very important to assess the position of cash from all internal resources. That means whatever the profitability has been available on the basis of cash profit would be important for the future planning. Next is dividend payments. Dividend decisions cannot be based on net profit. Of availability of cash is also important for dividend disbursement. That means the dividend cannot be decided and the percentage of dividend has not to be finalized on the basis of the amount of the profitability retained and earned by a company. It is actually understood on the basis of the how much liquidity and cash is available to disburse for a dividend payout. Therefore, cash generation by operating activities assumes importance for dividend declaration also. Next objective is details of investing and financing activity. It provides informations about a flow of cash from non-operating activities under the two heads, namely investing activities and financing activities. It means that all these informations were interconnected for the non-operating activities and also under the considerations of whatever the non-operating activities would be recorded under the head of operational activities. But whatever the non-operating activities like investments, purchasing of fixed assets, selling of fixed assets, and any amount of interest and dividend received on your investments, then if you borrowed some amount of bank loan, issued share capital, paid dividend on equity share and preferences, paid interest on debentures, such non-operating activities are to be considered under the banner of this particular heads. So besides information about internal financing provides by cash flow from operation activity or from operating activity, it provides information about external financial investments of cash resources. So this is actually a balancing of internal part of informations would be getting for taking a future path of understanding. Next is tool for planning. Cash flows of an enterprise provides a basis of evaluating the ability of an enterprise to generate cash and timing and certainty of their generation. It means the exact amount of time to be identified, where the fund has been required, for which object is required, and how much density of the fund has been required. That means the fund generated for the specific certainty and the timing is very much important. So the cash flow statement is one of the important tool for budgetary planning. Cash planning and preparations of cash budget is on the basis of historical analysis. That means the amount of data is available, analyze the data, what was the past situations, how the cash were very much affected and the cash management is efficient, and on the basis of that they would be designed for the future planning of cash and the cash informations for consideration of future policy. The amount of that it is considered as a tool for planning. Moving to the next point, that is limitation of the cash flow analysis. Here I just want to mention that it is a useful tool for financial analysis. That means it's one of the best tools for the financial analysis because of the cash management can be designed out of the cash flow analysis. But however, it has their own limitations. Why? Because of it cannot be equated with the income statement. And income statement takes into account both cash as well as non-cash items, and therefore net cash flow does not necessarily mean net income of the business. So many times it actually creates the limitations. The cash balance as divided by the cash flow statement may not represent the real liquid position of the business, for it can be easily influenced by postponing purchases and other payments. Because of the certain period of time, the cash balance may not be understood as the cash flow statement has been represented. So in that sense, sometimes you wanted to take a decision to purchase some amount of assets or maybe for working capital expenditures, but at that point of time, because of the not information is available, that you may not be taking a decision for the same. Cash flow statement cannot replace the income statement or fund flow statement. Each of them has a separate function to perform. Here, the working capital being a wider concept of funds, and the fund flow statement represent to us a more and more complex picture than a cash flow statement, because of the fund flow statement has represent the whole changes of a working capital, and they represent the net working capital situation, where the cash flow statement is not represent in that regards, because of it requires and it consider only the cash changes. In spite of this limitations, I want to mention here, it can be said that the cash flow statement is a very much useful supplementary instrument for the cash management. It reveals the volume as well as the momentum at which the cash flows in the different areas, different segments of the organization. So it reflects that all the different part of the activities regarding the cash has been reflected. The method of cash flow analysis, when used in combination with the ratio analysis, serves as an indicator and measuring the profitability and the financial position of the business. Here, this is what all about the limitation of a cash flow statement. Moving to the next point, that is a difference between the cash flow and the fund flow statement. As we already discussed the differences earlier, one or two differences of the cash flow and fund flow. Here I am going to tell you the major differences and the differences including the previous one regarding the difference of the cash flow and fund flow statements. Here, in case of a cash flow statement, it is deal with flow of cash on hand as well as in the bank balance payable on demand and cash equivalents, where it deals with the flow of networking capital. That networking capital, that is current assets minus current liability. So here it's represents only cash and cash equivalents. In the fund flow statement, it represents the networking capital, which is a difference between the current assets and current liability. In cash flow statement, it analyzes the balance of current assets and current liabilities and difference various sources and uses of cash. In the case of fund flow statement, it does not analyze the change in the structure of a net working capital, as it is not relevant to determine the sources and uses of a net working capital. In the case of the cash flow statement, it is used a short range planning, as the cash projections are more relevant to the business. In the case of fund flow statement, it is useful for long-term planning. Moreover, cash projections for a long period of time are not very accurate. So here, in case of a long period time for the cash management may be effective, but in case of the fund flow statement, it may not be affected. The next point is that is important. Changes in current assets and current liabilities may inversely related to the cash. In case of the fund flow, there is direct relationship between the changes in current assets and current liabilities, because of it's based on a net working capital. The another one point is to calculate the cash from operations, funds from operations and adjusted changes or adjusted to the changes on operational profit are to be considered in the